Snowflake stock is up 41% over the past 6 months, but there are some very important warning signs about this stock that you need to know. We're going to take a look at the financials as well as the valuation of this company to understand is it a buy or not. And we're going to go ahead and dive into these numbers here. So we're comparing April 30th, 2025 earnings, that's their most recent earnings report, compared to 2024. So 2024 April 30th earnings, you had $829 million in revenue for rounding up, compared to 2025, which were $1,042 million of revenue, and so very strong revenue growth. However, operating loss did increase from $348.5 million operating loss to $447 million in operating loss, as well as net loss was also worse, trending in the opposite direction that you wanted to. It was about $318 million net loss in 2024, and that actually accelerated to about a $430 million net loss here in 2025. So what I want you to understand about this stock is that there's a lot of hype around it, but the company overall is becoming less profitable. And by less profitable, I mean it's actually losing money at a faster pace. So yes, you do have revenue growth, but you are seeing a huge amount of money starting to be lost by this company. And yes, they do have a good amount of cash on hand to support these losses. And January 31st, 2025, they had about $2.6 billion in cash and cash equivalents, but that has now decreased. That declined close to $400 million quarter over quarter, as well as short-term investments also declined about $300 million. So the company is burning cash. They are, however, growing revenue, but it's important to understand that this company is not profitable, and it's also trading at a very high price on a price to sales basis. Note there's no price to earnings ratio because there are no earnings for this company. It is not profitable by any means, but we're going to take a look at the price to sales ratio as well as the price to cash flow and compare that to a similar cloud computing company like Oracle. Yes, I understand they are two very different companies, but we have to understand what a profitable company in the cloud space looks like and what it's trading at versus a company that is not profitable at all by any means in the cloud space. So you're looking at a price to sales ratio of 19.5 and a forward price to sales ratio of 16.6. If we compare that to Oracle's, they're trading a price to sales of 11.2 and a forward price to sales ratio of about 9.8. So much cheaper to buy Oracle, very much more expensive to buy a company like Snowflake, which is not even close to profitable. Price to cash flow, you're paying 90 for price to cash flow. Compared to Oracle, you're paying a price to cash flow of 31. So what I'm trying to point out here is that you're paying a very high premium for a company that is not profitable by any means. And yes, you could argue that, well, they're growing the revenue very quickly and the company has a very valuable product in a trending industry, so that may deserve a higher premium. But what I'm trying to convey to you is the fact that you're paying at face value so much more of an expense to own this stock. You're paying a higher price here to own a stock that's not even close to profitable. So you're not going to see immediate growth in terms of the financials and fundamentals of this company, especially at the direction they're heading, which they're actually accelerating their overall losses. So I would heed a lot of caution in wanting to buy this company. Although it is an attractive product they offer in a very much booming industry, you do need to consider how these losses are actually accelerating. There's a lot of concern there. In terms of the analyst ratings and what the price forecasts are, 81% buy, 15% hold, 4% sell. You're looking at a median price target of $230, and we're currently at $223 for the current price of the stock. So not a whole lot of room to grow in terms of analyst ratings. Then again, analyst ratings are not really that useful, but I want to point out to you what's very useful is some sort of comparisons with the metrics of what you're paying for this stock compared to one that's very profitable. But more importantly, is the company making more money, or are they trending in the right direction towards eventually being profitable? And right now, we're not seeing that in these financial statements from this company. So hey, if you have a differing opinion, let me know in the comments. I'm not trying to say that I am absolutely right about this company. I do think it has an attractive product, but in terms of a stock, it is very expensive and it's not heading in the right direction in terms of profitability. If you got value from the video, consider subscribing. Y'all have a good one.